This accommodative policy should support further progress toward our statutory objectives of maximum employment and price stability. Based on the economic outlook, the committee continues to anticipate that gradual increases in the federal funds rate over time are likely to be consistent with achieving and maintaining our objectives. However, recent economic indicators have been mixed, suggesting that our cautious approach to adjusting monetary policy remains appropriate. As always, our policy is not on a preset course, and if the economic outlook shifts, the appropriate path of policy will shift correspondingly. I will come back to our policy decision, but first I will review recent economic developments in the outlook. Economic growth was relatively weak late last year and early this year. Some of the factors weighing on growth were expected. For example, exports have been soft, reflecting subdued foreign demand and the earlier appreciation of the dollar. Also, activity in the energy sector has obviously been hard hit by the steep drop in oil prices since mid-2014. But the slowdown in other parts of the economy was not expected. In particular, business investment outside of energy was particularly weak during the winter and appears to have remained so into the spring. In addition, growth in household spending slowed noticeably early in the year, despite solid increases in household income, as well as relatively high levels of consumer sentiment and wealth. Fortunately, the first quarter slowdown in household spending appears to have been temporary. Indicators for the second quarter have so far pointed to a sizable rebound. This recovery is a key factor supporting the committee's expectation that overall economic activity will expand at a moderate pace over the next few years. Despite lackluster economic growth, the job market continued to improve early in the year. During the first quarter, job gains averaged nearly 200,000 per month, just a bit slower than last year's pace. And the unemployment rate held near 5%, even though notably more people were actively looking for work. However, more recently, the pace of improvement in the labor market appears to have slowed markedly. Job gains in April and May are estimated to have averaged only about 80,000 per month. And while the unemployment rate fell to 4.7% in May, that decline occurred because fewer people reported that they were actively seeking work. A broader measure of unemployment that includes individuals who want and are available to work but have not searched recently, as well as people who are working part-time but would rather work full-time, has flattened out. On a more positive note, average hourly earnings increased 2.5% over the past 12 months, a bit faster than in earlier years, and a welcome indication that wage growth may finally be picking up. Although recent labor market data have on balance been disappointing, it's important not to overreact to 1 or 2 monthly readings. The committee continues to expect that the labor market will strengthen further over the next few years. That said, we will be watching the job market carefully. Ongoing economic growth and an improving labor market underpin our inflation outlook. Overall consumer price inflation, as measured by the price index for personal consumption expenditures, was about 1% over the 12 months ending in April, still short of our 2% objective. Much of this shortfall continues to reflect the effects of earlier declines in energy prices and lower prices for imports. Core inflation, which excludes energy and food prices, has been running close to 1.5%. As the transitory influences holding down inflation fade, and as the labor market strengthens further, the committee expects inflation to rise to 2% over the next 2 to 3 years. Our inflation outlook also rests importantly on our judgment that longer-run inflation expectations remain reasonably well anchored. However, we can't take the stability of longer-run inflation expectations for granted. While most survey measures of longer-run inflation expectations show little change on balance in recent months, financial market measures of inflation compensation have declined. Movements in these indicators reflect many factors and therefore may not provide an accurate reading on changes in the inflation expectations that are most relevant for wages and prices. Nonetheless, in considering future policy decisions, we will continue to carefully monitor actual and expected progress toward our inflation goal. Let me now turn to the individual economic projections submitted for this meeting by FOMC participants. As always, each participant's projections are conditioned on his or her own view of appropriate monetary policy, which in turn depends on each person's assessment of the multitude of factors that shape the outlook. Participants' projections for growth of inflation-adjusted gross domestic product are slightly lower in the near term than the projections made for the March FOMC meeting. The median growth projection now remains at 2% through 2018, in line with its estimated longer run rate. The median projection for the unemployment rate edges down from 4.7% at the end of this year to 4.6% in the next 2 years, somewhat below the median assessment of the longer-run normal unemployment rate. The median path of the unemployment rate is little changed from March. Finally, the median inflation projection stands at 1.4% this year, a bit firmer than in March, and then rises to 1.9% next year and 2% in 2018. Returning to monetary policy, as I said, the committee maintained its target range for the federal funds rate. This decision reflects the committee's careful approach in setting monetary policy, particularly in light of the mixed readings on the labor market and economic growth that I have discussed, as well as continuing below-target inflation. Proceeding cautiously in raising our interest rate target will allow us to verify that economic growth will return to a moderate pace, that the labor market will strengthen further, and that inflation will continue to make progress toward our 2% objective. Caution is all the more appropriate given that short-term interest rates are still near zero, which means that monetary policy can more effectively respond to surprisingly strong inflation pressures in the future than to a weakening labor market and falling inflation. Although the financial market stresses that emanated from abroad at the start of this year have eased, vulnerabilities in the global economy remain. In the current environment of sluggish global growth, low inflation, and already very accommodative monetary policy in many advanced economies, investor perceptions of and appetite for risk can change abruptly. As our statement notes, we will continue to closely monitor global economic and financial developments. We continue to expect that the evolution of the economy will warrant only gradual increases in the federal funds rate. We expect the rate to remain for some time below levels that are anticipated to prevail in the longer run, because headwinds weighing on the economy mean that the interest rate needed to keep the economy operating near its potential is low by historical standards. These headwinds, which include developments abroad, subdued household formation, and meager productivity growth, could persist for some time. But if they gradually fade over the next few years, as we expect, then the interest rate required to keep the economy operating at an even keel should move higher as well. This view is consistent with participants' projections of appropriate monetary policy. The median projection for the federal funds rate rises only gradually to 1.5% at the end of next year and 2.5% by the end of 2018, somewhat below its estimated longer-run normal level. Although the median federal funds rate at the end of this year is unchanged from March, a number of participants revised down their projections. For 2017 and 2018, the median projection is 1/4 to 1/2 percentage point lower than in March, roughly in line with the 1/4 percentage point downward revision made to the estimated longer-run level of the federal funds rate. As I've noted on previous occasions, participants' projections for the federal funds rate, including the median path, are not a fixed plan for future policy. Policy is not on a preset course. These forecasts represent participants' individual assessments of appropriate policy, given their projections of economic growth, employment, inflation, and other factors. However, the economic outlook is inherently uncertain, so each participant's assessment of appropriate policy is also necessarily uncertain, especially at longer time horizons, and will change in response to changes to the economic outlook and associated risks. Finally, the committee will continue its policy of reinvesting proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. As highlighted in our policy statement, we anticipate continuing this policy until normalization of the level of the federal funds rate is well underway. Maintaining our sizable holdings of longer-term securities should help maintain accommodative financial conditions and should reduce the risk that we might have to lower the federal funds rate to zero in the event of a future large adverse shock. Thank you. I will be happy to take your questions.
Sam?
Thanks very much. Sam Fleming from the Financial Times. One of the big uncertainties hanging over markets right now is clearly the vote in the United Kingdom next week. How much of a factor was that in today's decision relative to the questions you've elucidated about the domestic jobs numbers and inflation data? And could you talk a little bit about the channels that you think about when you talk about the potential impact of a Brexit on the U.S. economy? Thank you.
Well, Brexit, the upcoming UK decision on whether or not to leave the European Union is something we discussed, and I think it's fair to say that it was one of the factors that factored into today's decisions. Clearly, this is a very important decision for the United Kingdom and for Europe. It is a decision that could have consequences for economic and financial conditions in global financial markets. If it does so, it could have consequences in turn for the U.S. economic outlook that would be a factor in deciding on the appropriate path of policy. So it is certainly one of the uncertainties that we discussed and that factored into today's decision.
Steve, and then we'll go to Jason.
Thank you. The Fed's outlook for rates has come down sharply for 2018 especially, but it's been coming down gradually over time, almost a full percentage point in some cases compared to a year ago. And yet the GDP outlook remains the same. What has happened in say, just the past quarter to the committee's outlook for rates to bring it down so much for, say, 2018, where it's now just 2.4%, and further from the long run than it was, say, in the prior estimate that was out there? Has there been a dramatic change in the committee's view on the relationship of GDP to rates? And maybe you could also explain why the Fed has to keep lowering these rates and getting that forecast wrong.
So as I mentioned in my opening remarks, there is really a great deal of uncertainty around each individual's assessment of the appropriate level of rates, particularly as we go further out in the forecast horizon and when we come to the long term. And I think what we can see and what many econometric and other studies show is that the so-called neutral rate, namely the level of the federal funds rate that is consistent with the economy growing roughly at trend and operating near full employment, that rate is quite depressed by historical standards. Many estimates would put it in real or inflation-adjusted terms near zero. Now, the path that you see in the dot plot for rates over time is importantly influenced. There is accommodation, and as we achieve our objectives, I think most participants feel that the accommodation in the current stance of policy needs to be gradually removed. But a very important influence in the out years is what will happen to that neutral rate that will just keep the economy operating on an even keel. And I've often in my statements and remarks talked about headwinds that reflect lingering effects of the financial crisis. To the extent that there are headwinds, I think many of us expect that these headwinds would gradually diminish over time, and that's a reason why you see the upward path for rates. But there are also more long-lasting or persistent factors that may be at work that are holding down the longer-run level of neutral rates. For example, slow productivity growth, which is not just a U.S. phenomenon, but a global phenomenon. Obviously, there is a lot of uncertainty about what will happen to productivity growth, but productivity growth could stay long for a prolonged time. And we have in aging societies in many parts of the world that could depress this neutral rate. And I think all of us are involved in a process of constantly reevaluating where is that neutral rate going, and I think what you see is a downward shift in that assessment over time, the sense that maybe more of what's causing this neutral rate to be low are factors that are not going to be rapidly disappearing, but will be part of the new normal. Now, you still see an assessment that that neutral rate will move up somewhat, but it has been coming down, and I think it continues to be marked lower. And it is highly uncertain for all of the dots.
Hi, I'm Jason Lang with Reuters. The median participant forecast for the Fed funds rate for 2017 and 2018 came down quite dramatically, but this stands in contrast with the 2016 median forecast. As you mentioned, there were a number, actually 6 participants who saw only one rate hike this year. Can you comment on what it would take for 2 rate increases to be the likely or appropriate policy path? And about this disconnect between the median view and the view of the, say, the voting members of the committee?
Well,
if there is one, I should add. Thank you.
Well, I'm not going to comment on participants versus voters. Monetary policy, the committee feels that monetary policy, when we're looking at several years, we should show the public what the views are of all the participants in the committee, especially given that voting rotates every year, and so that's a decision we made. But you asked me what it would take to have 2 increases. So, the committee as a whole never discusses how many increases should we have this year or next year. That's not a decision we're making as a committee. We're making decisions on a meeting-by-meeting basis and trying to give a sense to the public of what we're looking for and what the basis of a decision will be. And as I indicated, first of all, international uncertainties loom large here. We mentioned Brexit, the UK decision. Obviously, how that turns out is something that will factor into future decisions. And we're also looking at the prospects for economic growth and continued progress in the labor market. The forecasts that you see in the SCP and the statement indicate the committee continues to expect we will have moderate growth. 2% growth, suggests healthy growth for the rest of the year and a pickup in growth in the second quarter. And we expect to see continuing progress in the labor market. Now, we had questions about the growth outlook because we did see slower growth in the fourth quarter and in the first quarter. I have to say there, with respect to the slowdown we saw in consumer spending, that seemed to be out of line with fundamentals. We expected it to pick up, and we've seen very good evidence that it has picked up. But now the labor market appears to have slowed down, and we need to assure ourselves that the underlying momentum in the economy has not diminished. So, as I said, we will be carefully assessing data on the labor market to make sure that job gains are going to continue at a pace sufficient to result in further improvement in the labor market, and we will be watching the spending data to make sure growth is picking up in line with our expectations. Of course, with respect to inflation, we're constantly evaluating whether or not incoming information is roughly in line with our expectations. So we will be evaluating that at every meeting. Every meeting is live, and we could make a decision at any meeting to adjust the funds rate, but that's the kind of thing that we will want to see to make such decisions.
The Fed created a labor market conditions index a couple years ago that was designed to sort of bring together a lot of these factors in the labor market that you've talked about. As I'm sure you know, it's been falling since January. That suggests to some people that it was your decision to raise rates in December that has caused this weakening in the labor market. Could you address what role, if any, you think the Fed's decision to raise rates has played in the slowdown we are now seeing?
Well, let me just say the Labor Market Conditions Index is a kind of experimental research product that's a summary measure of many different indicators. And essentially, that measure tries to assess the change in labor market conditions. As I look at it and as that index looks at things, the state of the labor market is still healthy, but there's been something of a loss of momentum. The 200,000 jobs a month we saw, for example, in the first quarter of the year, that's slowed in recent months. Exactly what the reasons are for that slowing, it's difficult to say. It may turn out, again, we should never pay too much attention to, for example, one job market report. There's a large error around that. We often see large revisions. We should not overblow the significance of one data point, especially when other indicators of the labor market are still flashing green. Initial claims for unemployment insurance remain low. Perceptions of the labor market remain fine. Data from the JOLTS on job openings continue to reach new highs. So there's a good deal of incoming data that does signal continued progress and strength in the labor market. But as I say, it does bear watching. So the committee doesn't feel and doesn't expect, and I don't expect, that labor market progress in the labor market has come to an end. we have tried to make clear to the public and through our actions and through the revisions you have seen over time in the dot plot, that we do not have a fixed plan for raising rates over time. We look at incoming data and are prepared for raising rates over time. We look at incoming data and are prepared to adjust our views to keep the economy on track. And in light of that data dependence of our policy, I really don't think that a single rate increase of 25 basis points in December has had much significance for the outlook, and we will continue to adjust our thinking in light of incoming data in whatever direction is appropriate.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.